If you are making this common mistake with order blocks and supply and demand zones, then listen closely. You are struggling with them because you're marking out any random zone, like this candle here, or this candle here, or this one for example, and you're just simply trying to ape in and buy from this order block here, sell from this one, and you're just getting wrecked every time. Now this is because you don't understand structure, which I explained in the last video, or you can go to my free course and learn more there. And also, you don't understand how supply and demand actually works in the market. So that's what we're going to be breaking down in this video. I hope you enjoy. What are order blocks? Order blocks are areas on a price chart where large numbers of buy and sell orders are concentrated. Order blocks can provide insights into where smart money, the big banks and trading firms are placing their trades, and can therefore be used as a form of market analysis and potential trade setup. However, it's important to note that order blocks are just one aspect of a larger trading strategy, and they should not be relied exclusively for making trades, which is why we use confluences, which you will learn all about in the following videos. So, what do they look like? In short, it's an area where there's a lot of buy or sell orders waiting to be triggered. And us as smart money traders, we attempt to get trades in and around these areas to trade alongside the bank's moves. So this is what they look like. We've got an example on the screen now. This here is also an order block, so it's just like a large number of candles, like a little consolidation zone, little accumulation zone, if you know what they are. And yeah, that's the most simplest way I can visually show it to you, is by showing you this image here. This is an order block, okay? This here is also an order block. Now you know what they look like, you may be wondering how you can use them. There's an example on the screen now of a drawing that I made. As we know, when price is bearish and is creating lower lows and lower highs, it is breaking structure to the downside. And the highs are strong highs, whereas the lows are weak lows. But why is price actually pulling back every time to create a lower high? It's because there's a large number of orders left behind from the big banks, etc. These are order blocks. These banks and institutions will drive price back up to these order blocks to trigger their large portion of sell orders in this bearish scenario, and then drive it back down, causing the break of structure. When they do this, they cause their buy orders to break even because they have multiple orders on both sides of the market, so that they can then profit from the sell orders. So they manipulate the market and it's run off an algorithm. And us as smart money traders, we need to identify these order blocks and try to get in alongside the market movers. So how would this look like in the real charts? I have an example now on the screen, and as you can see, we are bearish order flow, we have bearish structure. Price comes all the way back up to the order block before continuing to sell off. Of course, there's other reasons as to why we took this trade here, but you'll learn those in the later videos, or you can go to the free course and learn them right now. That's entirely up to you. But as you can see, we have bearish structure, bearish order flow. We come up, we come down, we break through this, and then we ultimately return back to this order block, which you can see here, before then going down towards this structure, continuing with the bearish high time frame structure. Moving on, we have supply and demand. What is supply and demand, you may be asking? The forex market and all other markets run off supply and demand, and of course emotions. But we cover emotions in a psychology course, etc. That's not what you need to know right now. Just keeping it simple, supply and demand runs the market, as it does with all business. When there is more supply than demand in a market, the price comes down. And when there is more demand than supply, the price goes up. It's literally that simple. When supply is in control, the order flow and structure will be bearish. When demand is in control, the order flow and structure will be bullish. Let's go back to the order block lesson. We said we want to buy from order blocks in a bullish market. These order blocks in a bullish market are called demand zones. As we can see here, high gets broken, we have this protected strong low, and we know that this high is most likely going to be a weak high, and it's going to get broken because we are bullish. Okay, so this order block here, you'll learn why we're only using this one candle and how this is an order block, but this is a demand zone. Okay, so when you're buying from order blocks, it's demand. When you're selling from order blocks, you're selling supply. In contrary to that, order blocks in a bearish market, as I just mentioned, are known as supply zones, and we want to sell from these areas. A supply zone is an area of increased selling pressure, and there are many short positions waiting to be triggered from smart money. So there's some key words I want you to be familiar with, and these are rally, base, and drop. Rally means buyers are exceeding sellers, which means bullish momentum. Base means buyers and sellers are equal to each other, which is usually a consolidation or an accumulation, whatever you want to call it. And drop means sellers are exceeding buyers, which will be bearish. There's typically two types of supply and demand zones, and they are called continuation zones and reversal zones. Continuation zones consist of rally base rally and drop base drop, whereas a reversal zone consists of rally base drops and drop base rallies. We'll go through some examples now so you can see what these look like and what they exactly mean. On screen we have our first example of a continuation zone, which in this case is a rally base rally, which makes up a demand zone. It creates a demand zone. As you can see, we have a rally first, then we have a base where price accumulates, and then we have another rally. So a rally is just a push to the upside. Because order flow is bullish and leaving behind demand zones, we know to enter a long position from this continuation zone. You'll notice that there's multiple zones you might look to enter from, but we enter from this one exactly, and you'll learn why in later videos. And if you go through the free course, you can also learn why this zone was chosen. Okay, so we have a rally, which is this impulsive move up. We then have a slight accumulation, which is the base. Then we have another rally, which breaks structure and creates a demand zone where we then enter from and target the weak highs. On screen now, we have our second example of a continuation zone, which in this case is a drop base drop, which, as we know, happens in a bearish market. So therefore it is a supply zone, and as you can see, we enter from this supply zone and target the low. So we have this impulsive drop here, a slight accumulation, which is the base, and another drop. This breaks structure. We're in a bearish market. This creates a supply zone, so we sell from this and we target the weak low. In this example now, we have our first kind of reversal zone, which is a drop base rally. So as you can clearly see, we have bearish order flow in here. We then have our drop, which is this impulsive aggressive move down. We then have our base where price accumulates, and finally we get our rally where price flips from bearish to bullish order flow. We enter from the base, which in this case is a demand zone because order flow shifted from bearish to bullish, and we get a nice long position hitting our take profit. So we're bearish, breaking structure in here. We then have our accumulation, and then we get a rally. So a drop base rally, this breaks the structure up there, flipping us from bearish to bullish. So this will be a reversal demand zone. Finally, we have this last example, a reversal zone, which is a rally base drop. Price rallies up, then it creates a base, creating a supply zone, and then it drops. We enter from this and we target the weak low. Very simple, very quick to break down. So now you know everything about order blocks and supply and demand zones. You're maybe wondering how you can mark this up and use it efficiently. So we'll be going through some examples in the chart, but for now, you have two choices. If you want to use supply and demand zones, you can mark it up like this, because a supply and demand zone comes from the selling or buying pressure. So before this move down, it's the buying pressure for a supply zone. So it's either this overall buy up before the sell down, and you'll use that, or it's the overall sell down before the buy up, and you'll use that for your demand. But you can just use the last candle instead, but this is really only viable when you've got engulfment. So you see how the candle of this, the body of this candle is bigger than the body of this candle? That's great, that's an engulfment. So then you can use this last one here as the supply zone. You'll need to test this out for yourself, which is what we do within my community and stuff. I give you all the concepts, you go ahead and create your own strategy, you backtest and stuff like that. That's what you need to do to be able to become a good trader. You need to put the work and time in and actually backtest and get comfortable in the market with different concepts. Then once you're comfortable with them concepts, I can then go ahead and actually help you if you need the help to refine and create your strategy. Or you can just take strategies that I give out in the free course and stuff like that. They all work perfectly fine, but it's up to whether you're comfortable with actually using that efficiently and not getting too overwhelmed or confused by it. In this example here, it's just the opposite, so we can use the overall sell before the buy as our demand zone, or we can refine it down to this last selling candle before this up move. In this one here, this isn't engulfing, but that's just a mistake on my behalf in this screenshot. I recommend only using these if that candle engulfs the green one. Okay, so we'll go through some examples now in the chart. So as we can see here, I'm not going to break down this trade, I'll break down another trade, but I just wanted to show you this example. It's a very clean example. This isn't always going to happen, as you can see, but nonetheless, it's good to train your eyes by seeing this. So we move up, we get this change character, we then look for our demand zone, we use this here, being engulfed. That's very nice. Price pulls back, enters here, you can then look for a trade to target this weak high. That gets taken out, break a structure, we're still bullish. We then look for our demand zone again, we find this green candle here, the last sell before the buy. It's also engulfed by this huge grey candle. This is perfect. We use this, price comes back, it respects it, we find a trade, and we target this weak high again, continuing the bullish trend. First off, in this breakdown, we're going to mark out our structure on the 15-minute time frame. We had this break structure to the downside here, followed by wrong tool, followed by a breaker structure to the upside right here, being a change of character. Okay, so we went from bearish and we're now bullish. So this is the example that I shared just. I just went with breaking this down real quick since it was already there, easy to do. We then respected this and we went ahead and broke this high. So we're still bullish, break a structure to the upside, and we're now retracing. So we're looking for our zone, which we know is this zone right here. Go ahead and use that. Okay, very simple. When price enters this zone, we go down to the 1 minute time frame. On the 1 minute time frame, we follow structure again. So break a structure there. We want this broken for our change character. We get a break structure down again. So we're just going to mark that up right now. 1 minute break structure to the downside. We now need that broken for our change character. So everything in here is internal, as you know from the last video, from the structure video. This is all internal. So for example, when this high gets broken here, that's not a change character. That's just an internal break to the upside. Our change of character comes when we get a body close above that. So right now we've wicked above it, but we need a body close above it. So we've wicked above it again, kind of consolidating for a bit. We sort of sweep that consolidation, sweep the accumulation with this here, and now we could probably expect it to go up, take out this buy side liquidity from these highs of the accumulation, and close above this high, giving us a change character, which we get right there. I'm pretty sure. Looks like it. Nope. Very close. So we'll just leave that there. and then we get it. So that's our change character right there. So now we can look for a buy. We can look to go long. However, in this example I took, I didn't actually go long right here like this, simply because doing so didn't give me enough risk to reward. I go for I need a minimum 2 or 3 to be happy with taking a trade. This was just under a 2, so I didn't take it. The way I actually took this trade, you might be a bit confused in this video, but I'll show you anyway, and you'll learn more about this in future videos, so it's all good. I actually waited for price to pull back and then trade the internal structure. So I'm not going to trade internal structure in here until we get that confirmation that we have gone bullish from the external. So when this external high gets broken and we have confirmed to have shifted back bullish on the 1 minute time frame, aligning with the 15-minute structure, which was bullish. Now afterwards, after this point, I can trade internal structure, meaning if we get a slight break like we get around here, when we get that right here, this slight break of this low, right, when we get that and then we get a break in opposite direction, being another change of character. So we get this break and then change of character on internal structure after this external structure. When we get that, I will take the trade. Because now the overall external structure on the 1 minute is in alignment with the external structure on the 15-minute. But also on a fractal concept, the internal structure on the 1 minute is in alignment with the external structure on the 1 minute. Okay, so I just covered this low here just to play it safe, because it's low. Swept the liquidity and actually moved up, creating the original break of the external structure, the original change character. So I just covered that, and I just targeted the weak high, because this high here is the weak high in a 15-minute time frame. If we actually zoom out, if we go back on the 15-minute time frame, you'll see that high is the weak high in a 15-minute. And then we can just place the order and let the trade play, and it hits take profit. Very simple. So obviously I used a couple of little concepts in here that I haven't really shown too much on YouTube yet, but more videos will coming out covering all these concepts and more. But if you want to learn all of these anyway and just skip waiting for me to release YouTube content, you can go ahead and click the link in the description for the free trading course, a $1,000 trading course, completely free for you guys. Or to take it a step further, you can join the community. So that's going to be it for this video. I will see you guys in the next one.